Some stories disappear, some are erased, and some are waiting to be uncovered. The Dark Bureau.
On Wall Street, nothing is left to fate. The motion of immense sums, trillions, doesn't depend on luck or intuition. Within every ticker, buried in every regulatory memo or analyst call, a deeper architecture is at work. The sprawling glass towers that dominate global financial skylines do not rise, or occasionally fall, on lone genius or bumbling error. Instead, behind their mirrored facades lies a deliberately engineered system, a lattice of tightly linked interests. This system joins multinational banks, credit agencies, and regulatory bodies together in a vast bureaucracy that is rarely seen, and even more rarely understood. The world remembers the crisis of 2008 as the product of greedy risk-takers, reckless lenders, or simply bad apples. But that explanation is convenient. The calamity did not spring from isolated actors, nor from unforeseen mistakes. It arose from the inner workings of a financial structure calibrated for opacity, a self-sustaining engine where profits, incentives, and accountability ricocheted between the same networked players. Collapse on a global scale, as was seen more than a decade ago, should have been unthinkable. But the real surprise was not that the system broke, but that its underlying vulnerabilities had been so thoroughly normalised. Years before millions lost jobs and homes, the blueprint was drafted. In the sanctums of high-rise boardrooms, in the pages of off-record meetings, in the dense settlements brokered by legal minds, new financial instruments took on lives of their own. These products, synthetic derivatives, off-balance sheet vehicles, nested tranches, were celebrated as cutting-edge tools to manage risk. Publicly, they promised stability. Privately, they converted uncertain futures into present profits, masking their true dangers behind legal ingenuity and financial complexity. Over time, even the government officers charged with protecting the public good started to depend on industry information, relying on models, data, and assurances provided by firms they were supposed to monitor. The result was a revolving door of alliances and an ecosystem where oversight became more ceremonial than substantive. Each time questions arose, the answer was always, trust the system. Layer by layer, the design became too dense for anyone to see the sum of its parts. By the time markets imploded, the blame assigned to a handful of CEOs or to scapegoated firms was already misdirection. The highly visible figures facing congressional hearings, the executives grilled for sound bites and headlines, were simply the most exposed tip of a submerged bureaucracy. Their performance in public was only the final act in a drama scripted much earlier, where distributed responsibility and shared incentives prevailed over individual intent. The true resilience of the system, its ability to bounce back, evade reform, or simply mutate, laid in its opacity. Regulations were constructed by panels where key players themselves had a hand in writing the rules. Rating methodologies were defined by agencies whose commercial interests were entangled with the institutions evaluated. Even the most ambitious reforms were filtered through committees that favoured complexity and plausible deniability over simplicity and enforcement. The structure was not a conspiracy, but a dense bureaucracy with layers of mutual reinforcement calibrated to keep risk flowing, exchanged, bundled, and perpetually resurfaced in new forms. The goal was singular: maintain the system, extract the maximum profit, and quarantine real consequences. A sincere reckoning with the financial collapse demands a map, not just a list of bankruptcies or a timeline of bad decisions, but a trace of the hidden code governing finance from New York to London to Frankfurt. The script is etched across conference calls, coded into cross-border contracts, and shadowed in the triplicate files of compliance departments. The lines between regulated, regulator, and rater blur when the same few institutions set the terms, mark their own homework, and circulate risk as easily as currency. In the chapters that follow, we will trace how ambiguity in language, fragmentation of oversight, and normalisation of risk allowed layers of danger to accumulate unchecked. Ours is not merely a story of who failed, but of how a system was constructed to ensure that failure, eventually, became all but inevitable. This sprawling architecture began to take shape in the deregulation decades at the end of the 20th century. The Glass-Steagall barriers separating commercial and investment banking buckled in the United States, while Europe crafted continental frameworks to encourage cross-border capital flows. Bankers, freed from old restrictions, became financial engineers, developing exotic products at a pace regulators could scarcely follow. These instruments, collateralized debt obligations, credit default swaps, and synthetic derivatives, were presented as the ultimate form of risk management. Yet in practice, they liberated capital for speculation and camouflaged exposure instead of reducing it. Ingenious structuring allowed high-risk bets to masquerade as safe assets. Legal teams, accountants, and consultants learned to engineer opacity, shuffling assets among affiliates, exploiting regulatory differences between legal jurisdictions, and burying danger deep in labyrinthine prospectuses. What emerged were the first clear transnational feedback loops. American and European banks, often using similar playbooks and employing overlapping personnel, shared both tools and tactics. London's financial district became a key hub, a global fog, through which risk could be funneled beyond national supervision. Rating agencies, Moody's, Standard & Poor's, Fitch, did not merely observe these developments, but actively facilitated them. Paid by issuers to grade complex securities, agencies supplied the all-important AAA ratings that allowed institutional investors, pension funds, insurance giants, municipal endowments, and even sovereign wealth funds to purchase assets otherwise considered uninvestable. Their imprimatur was itself a vital part of regulatory frameworks on both sides of the Atlantic. Meanwhile, government regulators, hampered by resource constraints, legal ambiguities, and the never-ending lure of the private sector, began to lose touch with the market's true risk contours. When new products hit the market, even the most diligent watchdogs found themselves deciphering instruments built by teams 2 steps ahead, legal reviews veiling enormous uncertainty behind technical jargon and ambiguous standards. Risk, instead of being tamed, was rendered invisible by procedure. As the structure achieved critical mass, a pattern of mutual dependency and systemic blind spots set in. Rating agencies' business models required a steady stream of securities to grade. Banks relied on the ratings to justify their holdings. Regulators wrote capital requirements based on confidence in both. Risk models, endlessly refined, grew increasingly detached from economic fundamentals. They measured volatility, not vulnerability. Public statements emphasized confidence, while internal memos quietly acknowledged complexity too formidable to fully audit. Challenges to consensus, for example, analysts raising red flags or lower-level regulators querying assumptions, were either overridden or marginalized. The cost of dissent was exclusion from lucrative deal flows and career stagnation. At this stage, complexity itself became the best defense. Readability yielded to opacity, accountability to plausible deniability, and curiosity to complicity. All parties were incentivized to play along, not to challenge, but to perpetuate the narrative that the system was under control. Early warning signals were subtle, sometimes invisible, and frequently dismissed. The first mortgage defaults in American suburbs rippled outward, not as alarms, but as minor aberrations in asset pools reviewed by European and Asian investors. The real risk travelled as data points buried in spreadsheets, whispers exchanged in compliance reviews, and minor anomalies flagged by internal audits. Repositories in London mapped rising derivative exposures. Suburban offices near Frankfurt noted puzzling discrepancies in asset quality. Risk managers in New York saw volatility tick upward, but explained it away with technical language: market correction, temporary illiquidity, unusual interbank rates. Reports of trouble filtered through layers of bureaucracy, often sanitized before reaching decision makers. The system's vast wiring blurred causality. Losses in Miami translated to distressed debt in Tokyo, to capital shortfalls in Frankfurt, and back to asset-backed notes in London. Risk was everywhere, yet nowhere easily located. The design had worked. Warning lights blinked, but the machine kept running, signals absorbed into complexity until denial was impossible. When unravelling finally came, it did so not as a single dramatic bang, but as a slow-motion cascade. Off-balance sheet vehicles that once hid risk froze under the pressure of falling asset values and liquidity evaporating from key markets. Special purpose entities, set up to keep debts invisible, could neither sell nor refinance their holdings. Regulators, confronted by the sudden collapse of interbank trust, coordinated emergency phone calls across continents, each facing an incomplete picture of true exposure. Lines once considered asset classes had become zones of speculation with no reliable pricing. Who held what and how deeply was a question without an immediate answer. Collateral calls, a coded, technical process, meant bankruptcies moved in waves, as one default triggered another. The panic during the summer and autumn of 2008 was technical, dense, and shrouded in a professional vocabulary that masked its human cost. Liquidity waterfall, counterparty risk, systemic event. But beneath the professional calm, world markets were freezing, trust between institutions breaking, and the real economy bracing for shockwaves. Institutional response was reactive. Governments and central banks unleashed unprecedented emergency interventions. Across international capitals, teams raced to stabilise markets. The US Federal Reserve and the European Central Bank pumped liquidity, issued guarantees, and coordinated bailouts. Yet as public scrutiny intensified, the feedback loops became unmistakable. Congressional hearings in the United States and parliamentary inquiries in Europe unpacked a mountain of internal emails, memos, and warning reports. Evidence mounted of repeated, ignored alerts. Analysts questioning core assumptions, compliance officers flagging irregularities, and even senior regulators circulating private warnings before being silenced by layers of bureaucracy and self-preserving culture. Testimonies revealed that in critical moments, responsibility had diffused entirely. Decision trails ended in committees, not individuals. What surfaced was a disciplined process of normalization, a culture where risk dispersal always trumped risk management, and the cost of asking hard questions was to be sidelined. The legal and regulatory aftermath unfolded with both spectacle and caution. Agencies brought civil cases, levied billions in fines, and extracted settlements from global banks and investment houses. Major financial institutions ultimately paid out sums large enough to draw headlines, but rarely lost their core structures or societal influence. Legal reforms touted greater transparency, enhanced capital requirements, and restrictions on certain high-risk tactics. But meaningful accountability for the architects largely stalled. Investigators, constrained by both political and practical considerations, opted for systemic stability over revolutionary change. The reforms, while tightening oversight in places, left critical loopholes untouched and systemic interlocks largely preserved. Compliance departments grew, risk models were updated, but the culture of distributed responsibility and networked complexity endured. In financial centres from Manhattan to Zurich, new boundaries emerged to address yesterday's risks. Old assets were rebundled, classified anew, and the intricate dance between regulator, rated and rater was quietly recoded, not replaced. For the public, the legacy was sharply felt, but unevenly borne. Job losses surged, home ownership rates tumbled, and entire communities, especially those at the economic margins, saw years of progress erased overnight. The global ripple effects strained public institutions, social safety nets, and, crucially, trust in the legitimacy of markets and governments. Yet the structural power balances shifted only incrementally. The institutional machinery of finance adapted, carrying the deeper lessons forward, not to reduce risk, but to better shield it from view. As the dust settled, a new lexicon of accountability arose. Compliance programs became digital, risk algorithms scooped up and processed invisible vulnerabilities. Oversight functions professionalised further. But the most essential incentives stayed intact. Profits were still tied to opacity, and complexity remained the system's greatest shield. Today, the scaffolding first exposed in the last crisis remains largely in place, even as it evolves with technology. National and international supervisors benchmark their standards against institutions still able to influence rulemaking. The fragile distinctions between regulator, regulated and rating agency continue to blur, with career pathways crossing between public and private roles. Efforts at reform, Basel standards, Volcker and Dodd-Frank rules, new European directives, have tweaked oversight but left room for innovation outpacing supervision. The fundamental architecture persists, a system that recodes risk, mutates incentives, and absorbs crises as necessary costs of doing business. As history edges forward, the archive of red-inked balance sheets grows, each a warning that unless underlying incentives and structural power networks change, the same calamity will recur, not from ignorance, but from the quiet success of an architecture built to outlast reform.